So, good evening, fellow colleagues. Today we are going to discuss the group account, that is, introduction to group accounts. Introduction to group accounts, which is the topic is actually under corporate reporting. Corporate reporting. Corporate reporting. Corporate reporting. So, introduction to group accounts. What we are going to lay emphasis on this introduction of a group of group account is that why accounting for group accounts, or let's say why accounting for a group of company, we need to follow certain concepts. So certain concepts are always defined in order to understand the implication of what we are doing, of what we are doing. So if I say certain concepts need to what's it called? If I say certain concepts need to define, this certain concept need to define. What I mean by the concept that need to define is that we have different a lot of terminology that we need to define, that need to define, that need to define. So if we define terminologies, then we are actually moving towards what the group account is all about. So, and having said that, excuse me, having said that, the terminologies or the concept or the term or the definition term that we need to understand before we lay emphasis on the group account. I repeat that while accounting for a group of companies, while accounting for a group of company, why accounting, why accounting for a group of companies, while accounting for a group of companies, we said certain concepts, certain concepts are always defined, are always defined. So certain concepts are always defined. So in order to understand the implication of what we are doing, of what we are doing. So this is basic thing that we need to understand, that while accounting for a group of companies, certain concepts are always defined in order to understand the implication of what we are doing. So the concept that we are referring to here, the concept that we are referring to here The concept, while accounting for a group of companies, certain concept is always defined to understand the implication of what we are doing. So the concept that we are talking about here is called definition term. Definition term. So number one definition term is that we need to understand the control. We need to understand the control. So if I say control, what I referring to as control here is that there's a power to govern the financial and operating policy of an entity. So that's what I mean by control. The power to govern the financial and operating policy of an entity, so as to obtain benefit from the activities. So as to obtain the benefit from the activities. So this is actually in accordance with the IFRS 3 and the IFRS 10. IFRS 3 and IFRS 10. That's what I mean by control. So control refers to what? Power to govern financial and operating policy of an entity so as to obtain the what? The benefit from the activities. So this is actually in accordance with what? IFRS 3 and what? IFRS 10. Another thing that we also need to note is that of what's it called? Subsidiary company. Subsidiary company. This subsidiary company referred to as an entity that is controlled by another entity. So that's what I mean by subsidiary. An entity that is what? Controlled by what? By another entity. Known as what? Parent. Known as parent. So this is actually what? In accordance with IFRS 10. In accordance with what? IFRS 10. So if I said the subsidiary, I repeat, subsidiary is an entity, that is controlled by another entity. So if entity A is control entity B, if entity A is control entity B, so this entity B, it is known as what? Subsidiary. It is known as subsidiary. While entity A, it is known as what? Parent. It is known as what? Parent. It is known as what? Parent. It's known as parent. It's known as parent. That's what I mean by subsidiary company. That is why I said the subsidiary company is an entity. Is an entity that is controlled by another entity, known as what? Parent. Known as parent. So subsidiary company is an entity that is controlled by another entity. So entity B is controlled by entity A. So subsidiary company is an entity that is what? That is controlled by another entity, known as what? Parent. Known as parent. Known as parent. Another thing that we also need to uh, talk about. Another thing that we also need to talk about, it is that parent company. That parent company. So if I say parent company, what I'm referring to here is that an entity that has one or more subsidiary, That's what I mean by parent company. Parent company is an entity that what? That has one or more what? Subsidiary, one or more subsidiary. That is, entity A can acquire entity B. That same entity A can also acquire entity C. That same entity A can also acquire entity B, and so on like that. That's why we say a parent company is an entity that has one or more subsidiary. One or more subsidiary. This is actually in accordance with what? IFRS 10. in accordance with what? IFRS 10. In accordance what? IFRS 10. In accordance of what? IFRS 10. Another thing that we also need to talk about, it is a group account. Group account. Another thing that we also need to talk about, it is what? The group account. So if I say group account, what I mean by group account is that when there is what? When a parent and all the subsidiary companies, that's what I mean by group account. A parent and all the subsidiary company, that's what I mean by the word, the group, the group company. The group company, referred to as what? A parent and all its subsidiary. A parent and all its subsidiary. That's what I mean by the group company. Group company consists a parent and all its subsidiary. Group company consists a parent and what? And all its subsidiary. That's what I mean by what? The group company. I repeat, group company consists of what? A parent and all its what? Subsidiary. And all its what? Subsidiary. That's what I mean by group company. Group company. Another definition of terms that we also need to talk about is that of what's it called? Consolidated of financial statement. Consolidated of what? Financial statement. Financial statement. So if I say consolidated financial statement, what I'm referring to here is that the group account that contains the financial statement of both holding and what? Subsidiary company. That is what I mean by what? Consolidated of financial statement. That is the group account. And that group account we now what's it called? We now contain both the financial statement of the parent company and also the financial statement of what? Subsidiary companies. That's what I mean by the word consolidated uh, consolidated statement of consolidated of financial statement. Consolidated of financial statement. That is a parent company, or we call them holding company. So the parent company, the financial statement of the parent company, and also financial statement of what? Subsidiary company. Whether the subsidiary they are four, that is why I said the consolidated or financial statement consists the group account. The group account of what? Of financial statement of both parent company and what? Subsidiary companies. Subsidiary companies. So that's also one of the terminologies that we also need to learn. Another thing that we also need to learn as part of terminology is that when you have what's it called? Positive goodwill. Positive goodwill. Positive goodwill. Positive good. So this positive goodwill arises as a result of if there is a excess of what? Purchase consideration over the fair value of what? Identifiable net asset of the subsidiary. So if the purchase consideration is higher than the what's it called? The fair value of identifiable net asset of the subsidiary, then we have what is called what? Positive goodwill. Positive goodwill. Positive goodwill. So positive goodwill occur or arises as a result of what? Excess of purchase consideration over the fair value of what? Identifiable net asset of what? Of what? Of subsidiary. Of subsidiary. Of subsidiary. Of subsidiary. So that's what I mean by what? The positive goodwill. Positive goodwill. Positive goodwill. So another thing, part of the definition term or terminologies that we also need to look into is that of what the negative goodwill, negative, or we call it gain on bargain, gain on bargain purchase, gain on bargain purchase, gain on bargain purchase, gain on bargain purchase, gain on bargain purchase goodwill. So gain on bargain purchase goodwill arises or occur as a result of what? When the purchase consideration is lower than the fair value of what? Of identifiable net asset of the subsidiary. Identifiable net asset of the subsidiary. So, the first one, when we say purchase positive goodwill, we said when the purchase consideration is higher than the what? Than the fair value of net asset of what? Identifiable net asset of the subsidiary. So it is the opposite. But when they say negative goodwill, or we call it gain on bargain purchase, so this occur as a result of the when the purchase consideration is lower than the fair value of what? Identifiable net asset of what? Of subsidiary. So these are the what's it called? The terminologies that we need to understand. The terminology that we need to understand. Another terminologies that we also need to understand here is that what's it called? Pre-acquisition, 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 pre-acquisition of retained earnings. Retained earnings. Pre-acquisition of what? Retained earnings. So pre-acquisition of what? Retained earnings. So pre-acquisition of retained earnings arose. So pre-acquisition retained earnings. So this is the earnings that is arose before the acquisition of the business or before the acquisition of the subsidiary. So that's what I mean by what? Pre-acquisition retained earnings. So pre-acquisition retained earnings arose before the acquisition of what? Of the subsidiary. So that's what I mean by pre-acquisition retained. That is the retained earnings that is arose before the subsidiary was what? Acquired. So another point that we also need to note is that post-acquisition of what? Retained earnings. Retained earnings. Retained earnings. So this is the opposite of pre-acquisition. So post-acquisition retained earnings arises when as a result of what? After the acquisition of the subsidiary. That's what I mean by post-acquisition retained earnings. That is the retained earnings that is arose after the acquisition of what? Of the subsidiary company. After the acquisition of what? Subsidiary company. That's what I mean by post-acquisition retained earnings. Post-acquisition retained earnings. Post-acquisition retained earnings. So once you understand all these terminologies, then we are good to go. We are good to go. So another thing that we also need to discuss is that of the consolidated statement of what? Statement of what? Financial position. Consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. So this consolidated statement of financial position, we need to talk about the reason for consolidating account. What are the reasons for consolidating account? So the reason for consolidating account is that for a group company to be properly run, so it is now necessary to consolidate the accounts of the holding companies. If I say holding companies, we are talking about the parent company. So for a group company to be what properly run, so it is necessary to what to consolidate the account of what the holding company with that of what that of its subsidiary and what is it called associated companies. So as a result of that, we have some reasons, different reasons why we consolidate accounts. Number one is that number one reason for consolidating accounts, reason for consolidating accounts. Number one reason of consolidating account is that number one reason of consolidating account is that in order to avoid misleading and what description. So number one is what is to avoid misleading and what incomplete description of the result of the investing of holding company. So reason of consolidating account, we can see that when you are trying to avoid misleading and incomplete description of the result of the investment of holding company. So that investment that the parent company or holding company we have in subsidiary and associate company. So that is the main reason that we need to consolidate that account so that it won't be mislead and incomplete description of the results of that parent company invest in the subsidiary and the associate company. Number two reason is that when you are dealing with the separate account of the parent and subsidiary company, there will be no reflection of profit and the profit earned through the investment in the subsidiary. So if you are doing a separate account, that is, you are doing a separate account for parents and also you are doing a separate account for a subsidiary, there won't be reflection of profit. There won't be reflection of profit earned through the investment of the subsidiary. So the profit that the parent will earn through the investment that the company that through the investment is holding in that subsidiary. So there won't be reflection if you are doing a separate account. That is, if you are maintaining a separate account, there won't be reflection of profit and the profit earned through the investment in the subsidiary. So there won't be reflection of the profit that the parent is earned through the investment in subsidiary. Another reason that we can also think of is that there will be no any information as how the fund which have not been distributed have been utilized. So if you are not maintaining consolidating account, definitely there will not be any information about the fund which have not been distributed. That is the fund that has not been distributed. So if you are not maintaining consolidating account, such information will not be there. That is, there will be lack of information. There will be lack of information as to how the fund which have not been distributed have been utilized. So another what's it called? Reason that we also need to think of is that what's it called? There will be no basis for comparing information supply. There will be no basis for comparing information supply to the shareholder of holding companies, to the shareholder of what? Holding company, with that of subsidiary, with that of subsidiary. Even though, and even the associate as well, even the associate as well. So if there is no consolidating account, if there's no consolidating account, there will be no what? Basis of what? Comparing information supply. So there won't be any basis that you can compare any information supplied by what? By the parent company with that of what? Subsidiary and that associate. So also, if we didn't consolidate account, if there is nothing like consolidating account, so the director of company, it will be easy for them, to avoid the what? Disclosure requirement of the company. Are you getting it? So if there is no consolidating, if there is no consolidating or consolidation financial statement, the director of company, what is it called? The director of company, we always avoid disclosure requirement. We also avoid disclosure requirements of the company. We always avoid disclosure requirements of the company. So these are the reasons. These are what? Reasons for what? Consolidating accounts. These are what? Reason for what? Consolidating accounts. So another thing that we also need to think of is that the way the control can be what? Can be take place. The way control can be what? Take place. The way control can be what? Take place. Number one is that control can be take place through wholly. Control can be take place through what? Wholly owned subsidiary. Subsidiaries. So control can be what? Take place through what? Wholly subsidiary. What this implies is that if a parent company is holding 100% of 100%, that is, a parent company is holding 100% stake in the subsidiary, then we say it is what? Fully owned. We say it is what? Fully owned subsidiary. Yeah, we say it is a fully owned subsidiary. That's why we call it wholly owned subsidiary. Meaning, if the parent company takes what? 100% control, then we say it is what? Fully owned, or we call it wholly owned subsidiary. What is it called? Another way of taking stake, we call it what? Partly owned subsidiary. So this partly owned subsidiary implies that if the parent company is what? Having control, between 51% and above, between 51%, let's say, to what? 99%. Between 51% to 99%, we say it is what? Partly owned. So if the controlling interest is between 51% to 99%, we say it is what? Partly owned. partly owned, partly owned. We say it is what? Partly owned, partly owned, partly owned subsidiary, partly owned subsidiary. So these are things that you need to learn as what? As one of the basic things why computing for your what? For your statement of what? Financial position, and also statement of what? Profit or loss, another comprehensive income, comprehensive income, comprehensive income, comprehensive income. So another thing that we also need to learn here is that of, if the question given to you consists, if the question given to you consists of, if the question given to you consists of what's it called? Consists of statement of financial position and also statement of what? Profit or loss. If the question given to you consists of statement of financial position and also statement of profit or loss, statement of profit or loss, we have certain things that we also need to put in place. We have certain things that we also need to what? To put in place. Number one is that if there is what? Intergroup trading, intergroup trading or intergroup sales, or intergroup sales. If there's intergroup trading or intergroup sales, let's say relevant information to note while computing for consolidated statement of profit or loss and other comprehensive income, other comprehensive income. So the relevant information or relevant information to note while computing for what? Statement of profit or loss and other comprehensive income. Number one is that intergroup sales slash intergroup trading, intragroup sales slash what? Group trading, intragroup trading. So you also need to note that while computing for what? Statement of what? Profit or loss and other comprehensive income. You must take note of that as well. You must take note of that as well. When we said intragroup sales, or we call it intragroup trading, what we are trying to explain here is that when there is a sales between the group members, when you make sales between your group members, let's say we have entity A, entity B, entity C, entity D, they are group member. One person now makes sales between each other. You get it now? That's what I mean by intra-group sales or intra-group trading. So when you make sales between your group member, so how you are going to do the treatment? So the treatment the treatment is that that intragroup sales will be what? Eliminate from the revenue. That intergroup sale will be what? Eliminate from the revenue. That is the revenue minus that what? Intragroup sales, intragroup sales, intragroup sales. So when one member sell to what? To the group members, to the group member, we call it intra-group sales. And you have to remove that intra-group sales from what? From revenue. From revenue. So not only that, that same intra-group sales that you are removing from revenue, you also need to remove it from what? From the cost of what? Cost of sales. Cost of sales. Cost of sales. You are removing it from revenue. Also, you also need to remove it from what? Cost of sales. Cost of sales minus that intra-group trading or intra-group sales. Are we there?
Yes.
So another thing that we also need to talk about when you are computing for what's it called? The statement of a consolidated statement of P or L, another comprehensive income is that if there's investment income, so you need to understand that if there's what? Investment income, so only income from outsider should be what? Consolidated. Only income that is coming from outsider should what? Should be consolidated. Why what's it called? Why any income in form of dividend, probably there's income in form of dividend, in form of interest, and maybe other receivables from the subsidiary should be what? Should be eliminated from what? From the consolidated income. From consolidated income. I repeat, when you are dealing with a consolidated statement of P or L and other comprehensive income, the investment income, the only investment income that you need to consolidate is that of the investment income that comes from outsider. That is from outsiders, you have to consolidate them. But any income that come in form of dividend, dividend is an income. So any income that come in form of dividend, maybe in form of interest, maybe in form of other receivables from the subsidiary, all these things that I mentioned, if they are coming from the subsidiary, subsidiary is a member, but that is why I mentioned that the income that you need to consolidate should be the income that is coming from outsider, that is outside the group. You can consolidate those ones. But any income that is coming as a result of dividend, interest, and other receivable from the subsidiary should be what? Should be eliminated from the consolidated income. You have to eliminate them from the consolidated income. That is what I mean by eliminate, is that you have to remove it, you have to deduct it, subtract it from what? Consolidated income. Another thing that we also need to take note is that of finance cost. I've explained what's it called? Investment income. That is, it is only income that is coming from outsider that you need to consolidate. I've mentioned investment income, investment income. So, and I said this income, you can only consolidate the income that is coming from outsider. You can only consolidate the income that is coming from outsider, but any income that's come in form of dividend, interest, and other receivables from what? From subsidiary should be what? Eliminated from what? Consolidated income. So another thing that we also need to talk about is what? Finance cost. So this finance cost, the intra-group interest charge, the intra-group interest charge, intra-group interest charge. Are you getting it now? So this intra-group interest charge from subsidiary and associate company should be what? Eliminated from what? From consolidated finance cost. So any intragroup interest charge from subsidiary, if there is a interest charge from subsidiary, so and then not only subsidiary, probably associate, so you need to what? You need to eliminate them. You need to eliminate them from consolidated finance cost. You have to deduct them from what? Consolidated finance cost. From consolidated finance cost. From consolidated finance cost. So another thing that we also need to note is that of unrealized profit. Unrealized profit. Unrealized profit. Unrealized profit. So if I sell unrealized profit, so the treatment of this unrealized profit is very simple and straightforward. And if I sell unrealized profit can only arise as a result if there's what? There's a intergroup transaction. That is, if there's intergroup trading, that is one entity sell to other entity. And if entity A, for instance, if entity A sell to entity B, maybe it sell goods that worth $500 to entity B, and this entity B are unable to sell everything, before the reporting date. Then there's need for what? There's need to calculate unrealized profit. So you have to calculate the portion that remains. Maybe you sell the goods that worth $500 to entity B, and entity B only sold 80% of it before the reporting date. Then the remaining 20% you have to calculate unrealized profit. But if entity B sold everything, you don't need to calculate unrealized profit. But the treatment of this unrealized profit is that you have to add that unrealized profit to the cost of sale. You have to add that unrealized profit to the what? To the cost of sales. And also, if the subsidiary, is a seller, then the unrealized profit will have to be what? Deducted from its profit. So let's assume the seller is a subsidiary. So whatever unrealized profit let's assume the seller is a subsidiary. Whatever unrealized profit that you arrive, then you have to deduct it from the profit of that subsidiary. From profit of what? Of the subsidiary. But if the seller is a parent, then you don't need to remove it from the profit of what? Of the subsidiary. You don't need to remove it from the profit of what? Subsidiary. Take note of that. If the seller is a subsidiary, your unrealized profit will be removed or will be deducted from the profit of the subsidiary. But because the reason is that the seller has already recognized the whole profit. Now, since he now discovered that the good that is sold to one entity, that entity has not been what? The entity has still remained the portion of it in its inventory. Automatically, you have to compute the unrealized profit, and then you have to remove it from the profit that you've already recognized. But if the parent is a seller, So you don't need to remove the unrealized profit from the subsidiary profit. So, having said that, we can now look at the illustration. We can look at the illustration. We can look at the illustration. We can look at the illustration, and let's see what we are going to achieve from that illustration. That illustration. So, uh, so look at this illustration. Let's see what we are going to achieve from this illustration. The exotic groups, the exotic group carries on business as a distributor of warehouse equipment, an importer of fruit, an importer of fruit into the country, an importer of fruit into the world country. Exotic was incorporated in 2018 to distribute warehouse equipment. To distribute warehouse equipment. It diversifies its activities to include the import and distribution of fruits. To include import and distribution of fruits, and expanded its operations by the acquisition of shares in Melon in 2020 and in 2021. So the draft statement of profit or loss and other comprehensive income of the companies for the year ended 31st December 2021 as follows. So this is the draft statement. This is the draft statement. Another draft statement is the draft statement of financial position as at 31st December 2021 as follows. This is another draft statement. Then the following information is available. On 1st of January 2020, Exotic acquired 2,700, so 2,700,000 1 naira ordinary share in Melon for 6,650. At which so he acquired 2,700, 2 million. He acquired 2 million. He acquired 2 million. 2 million, what's it called? 700,000 at 1 naira shares in Melon. He now pay Melon. He acquired 2.7 million shares in Melon. Then he pays Melon 6,650,000. At which date where was a credit? Where is it? At which date there was a credit balance on the retained earnings of Melon of 1,425,000. No share have been issued by Melon since Exotic acquired it. B. At the date of acquisition, the fair value of identifiable net asset of Melon was 5 million naira. The excess of the fair value of the net interest is due to an increase in the fair value of non-depreciable land. Land cannot be depreciated, so that's why they say non-depreciable land. Non-depreciable land. So you can see that what they are referring to here is that the land cannot be depreciated. So that's why they said the non-depreciable land. Okay. C. On 1st of January 2021, Melon acquire 1,600,000 naira ordinary share in Kiwi. So we are told that Melon acquire Kiwi. Melon acquire Kiwi ordinary share. Melon acquire 1,600,000 naira ordinary share in Kiwi, and he pays Kiwi how much? 3.8 million. That's the amount he paid to Kiwi. At which date there was a what? Credit balance on the retained earnings of Kiwi, 950,000. So that's the retained earning. So no share have been what? This one is the retained earning here. So no share have been what? No share have been issued by Kiwi since Melon acquired its interest. D. During 2021, Kiwi had made intra-group sales. You can see intra-group sales. During 2021, Kiwi had made intra-group sales to Melon of 48,000, making a profit of what? 25% on cost, and 75,000 of these goods were were in inventories at 31st December 2021. So during 2011, Melon had made intra-group sales. So Melon also made intra-group sales. Exotic, making a profit of 25%. Making a 25% on sales, and 60,000 of these goods were in inventories at 31st December 2021. 6, which is F, an impairment test conducted at the year end did not reveal any impairment loss. So when they conduct impairment test, there is nothing like impairment loss. G, it is the policy to value the non-controlling interest at fair value at the date of acquisition. So the fair value of the non-controlling interest in Melon on 1st of January 2020 was 500,000. The fair value of the 28% non-controlling interest in Kiwi on 1st of January 2021 was what? 900,000. Require A. Consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2021, and also consolidated statement of financial position as at that date. It means that we are going to do consolidated statement of P&L and other comprehensive income, and also we do consolidated statement of what? Financial position. Are we there?
Yes, sir.
So we are good to go. Then before we do that, which is the first question they ask us to do. A, consolidated statement of profit or loss. Profit or loss.
IB ẹjọ ṣe lè bá a send the question yẹn sórí platform.
Other comprehensive income. Other comprehensive income for the year ended December 31st, 20 what? 20, let me see, 2021. 2021. So this is what we need to do. We just look at the question given to us, the draft of that POL. This is the draft of POL. We have sales revenue. This is exotic, melon, and kiwi. Sales revenue. We want to do consolidation. It's in 1,000. Sales revenue. So this sales revenue, you are consolidating 3 things. But before you do that, you have to make adjustments if there is need for adjustment, because I said in my explanation here, I said when you are doing the treatment of this statement of a profit or loss and non-comprehensive income, if there's intra-group sales, the treatment is that you are removing intra-group sales from revenue, and also you are removing it from what? Cost of sales. So my advice is that you have to do the working note. You have to do the working note. So when you do the working note, you can write, you can say working note 1. Working note 1. Then you can write the 3 entity: exotic, melon, and kiwi. Exotic, melon, and kiwi. So we want to do the adjustment, which is a working note 1. Let's say working note 1. And it will be good for us. It will be good for us if, because the question given to us contain, so don't let me call this one working note 1. I can say working note 2 later. So the question given to us is a question in form of group account. And I said that whenever you are dealing with group accounts, so the first thing that I also need to do is call the group structure. Structure the group. That is how the business was acquired. So when you structure the group, you know how the business was acquired. So let's try and structure the group and let's see. By structuring it, you will read it and see what and what acquire what. Exotic acquire 2,700,000 ordinary share. So let's say exotic. Let's say exotic let's say exotic, acquire 2,700,000 ordinary share in Melon. So exotic acquire Melon. Exotic acquire Melon. But how many percentage exotic acquire in Melon? It acquire, because they didn't give us percentage. It's a number. But it means that it acquire 2,700,000 shares. That's what exotic acquire. It acquire it from Melon. So divided by the Melon shares. Before they can say you acquire 2,700,000 from Melon. So how many shares do you think Melon has? So this is the number, this is the shares, equity share. You can see 1 naira ordinary equity share. So the middle one is Melon. Let's trace it. Melon, you can see 3 million naira. Then if you divide it by 1 naira, it means that it is 3 million shares. 3 million naira, because sometimes they will tell you that 50 kobo. You have to say 3 million divided by 50 kobo to know the number of shares. But this time around, it's 3 million. 3 million naira. That's the total amount of that share. 3 million naira. 3 million naira divided by 1 naira per share to know the number of shares. 1 naira per share. So whatever you get, you now say times 100. So you know the number of the percentage that exotic acquire. So it means that 1 naira divided by 3 million will still give you 3 million shares. So 2,700,000. This is what exotic acquire. Melon is holding 3 million shares. Melon is holding 3 million shares. And one person now came, which is exotic, and acquire. So that is 2.7 million divided by 3 million share multiplied by 100. So when you divide it, what do you have? Hello, are you there? So when you divide this, please figure me, what do you have? To know the percentage that exotic acquire. Because this question, they are not giving us percentage there. You have to do what? You have to get the percentage, because they are giving us in terms of number of shares. Then you have to calculate the percentage. Please figure me. Okay, go ahead, please.
Where do you get the 3 million from?
Go ahead. Alaji, go ahead.
Where do you get the 3 million from? The 3 million, where do you get it from?
Hello.
Where do you get the 3 million from?
That is the melon share.
That's the Melon shares. Because this is the ordinary 1 naira ordinary share, 3 million naira. That's the value of one naira ordinary share. Then if you want to know the number of shares, it means that there is something that they multiply with 1 naira. They multiply something with 1 naira to give them 3 million naira. So it means that they multiply 3 million shares, because 3 million shares times 1 naira, we give them 3 million naira. So that's what I said. Whatever value that you have here, just divide it with the 1 naira nominal value. So it is possible sometime they will give you 50 kobo. You have to divide it to know the number of shares. So what do you have now as the percentage acquired?
90.
90.
It means that it is 90%. So if the percentage acquired it is 90%, then the non-controlling interest will be 10%, which is the remaining balance. Because all the total percentage is 100. So if the 90% is for exotic, then the non-controlling interest will be what? 10%. So that's the first group structure. You now go ahead and see if there is no acquisition again. But part C here, there is acquisition there as well. They said on 1st January 2021, Melon acquire 1,600,000 share in what? Kiwi. So it is Melon that acquire Kiwi now. It is Melon that acquire Kiwi now. You can see Melon acquire Kiwi. It is Melon that acquire Kiwi now. So Melon acquire 1,600,000 in Kiwi. So divided by Kiwi. So before you can say you acquire 1,600,000 in Kiwi, how many shares do you think Kiwi is holding? So look at it. This is the last one is Kiwi. So 2 million naira. Then when the nominal value is 1 naira, then 2 million divided by 1 naira, it means that it is 2 million shares. 2 million shares. So the same procedure I used on the first one, 2 million shares. That is 2 million naira, because sometimes it can be 50 kobo. So 2 million naira divided by 1 naira nominal value. 1 naira nominal value multiplied by 100. So what do you have? What do you have, please?
80%.
80%. 80%. Now, as a result of this, you will discover that Exotic acquire Kiwi. Exotic acquire Melon. Exotic acquire Melon, then Melon acquire Kiwi. But this Exotic can still control Kiwi. Look at it, oh. Exotic acquire Melon, but Melon now acquire Kiwi. It means that this Kiwi, this Exotic can still control Kiwi. But if it is control Kiwi, we call it indirect control. Indirect what? Control. Then you have to compute what is called effective indirect control. Effective indirect sorry effective indirect control. Effective indirect control. Effective indirect control. And this effective indirect control will now be 90% multiplied by the 80%. Multiplied by the 80%. So this is what I mean by the effective indirect control. So 90 times 8, 9 times 8. That is 9 times
72.
8, 72%. 72%. So if you have 72% here as effective indirect control, then the non-controlling interest will be what? Will be 28%. Will be 28%. So this is your group structure. This thing that I did here, it is what? Group structure. It is what? Group structure. So after the group structure, then we can now move to what the examiner is asking us to do, that this consolidated statement of P or L, another comprehensive income, then revenue. And I said it is possible for you to just add the revenue together, exotic plus melon plus kiwi, if there is no intra-group trading or intra-group sales. But you can see from the question that we underline that there's intergroup sales. And I tell you the reason of intergroup. I said intergroup arises as a result if there is a sales, if there are sales between group members. If there are sales between group members, it is called intragroup sales or intragroup trading. Then I said if you have something like that, you have to do the working notes. So the working notes, you can say sales revenue is equal to, what is the exotic? Please, let's do it together. Be giving me figure. What's the exotic revenue? 45 in thousand.
45,600.
So let me put it in thousand. Thank you. So let me put the 1,000 here. Let me also put the 1,000 here. Let me also put the 1,000 here. So you said what?
5,600.
45,600. Melon,
24,700.
24,700. Kiwi,
22,800.
28,800.
22,800. Now, you remember the procedure I gave, that the treatment of this intragroup sales is that you have to do, or you eliminate intragroup sales from it. So you have to eliminate intragroup sales from it. If there is intergroup sale, you have to eliminate it. So intra-group sales. So you can now check your question. Is there intra-group sales? Let's see. Let's see. From part C here, they said, no, from part D. Part D, they said during 2021, Kiwi had made intra-group sales to who?
Melon.
To Melon. To Melon. Automatically, there's intergroup sales. It made it to what? To Melon. Kiwi made it to Melon. And I said you have to eliminate. Kiwi is a seller. Kiwi made it to Melon. So you have to eliminate it from that Kiwi. You eliminate it from Kiwi, from the seller. Then, who again? We've done that one. Who again?
Melon had made intergroup sales to exotic.
Melon had made intergroup sales to what? To exotic. Who is a seller?
Exotic.
Why exotic
Melon.
is a seller? Melon is
Yes,
a
sir.
seller. Melon is a seller. How much is that? 260.
260,000.
Then you can now cast. You can cast. So cast, please.
Seven
Under
forty.
melon. Under
This one is
melon is
45,600.
24,000.
Under melon,
24,440.
24,440. Under kiwi,
22,320.
22,320. So here you can say consolidate. That is the one that you are taking to consolidation. So just total, that's the consolidation. You know, this one is just working note. So consolidation, that is you want to total. You will say exotic plus melon plus kiwi. What do you have?
93,100.
93,100. Then what is the intragroup?
740.
740. You will subtract it.
92,360.
92,360.
360.
Now, so if you do something like this, are you getting it now? Look at it. This is for this. This is for this. This is for this. So if you want to prepare this one is working. You will still continue, but what you are putting under revenue, if you want to prepare the account, it is that consolidated part. This is what you are putting under your revenue, which is 92,360, because this is the revenue part. You can now come here. That one is just working note. You can now come here and put the value, because you already do the consolidation, which is 92,360. I think it's clear now. So after revenue here, what again? Cost of sales.
Cost of
Cost of
sales.
sales.
You write cost of sales. Cost of sales. Then you still come here under your working and start and continue. Cost of sale. And continue. Cost of sale. So what's the cost of sales of exotic? What's the cost of sales of exotic?
18,050 naira.
Eh?
18,050 naira. 18,050 naira.
Now, so when you are doing cost of sales of exotic, you don't need to put it. You need to adjust that one too, because I said it that when you remove intragroup sales from revenue, you also need to remove it from where?
Cost of sales.
From cost of sales. Then you have to open account for cost of sales as well, which is working note 3. Working note 3. Please take note of all these things. It is examinable. Exotic, melon, kiwi, and consolidate. So you now say balance as per draft or as per book. Balance as per draft. It means that, let me put the heading. Their cost of sales, is working note 3. Cost of sales. So the cost of sales given to you from the question, 18,000, 18,050 for exotic. That's running by balance as per draft. 18,050. Melon, 54.
5,453.
Okay. Kiwi,
5,320.
5,320. Then what's going to be the total? Total means consolidation.
28,833.
28.
833.
28 833.
833.
Please, hold on, give me like 2 minutes. Hold on, please, don't come. So I'm back. 28 833. So that's the balance as per draft. Then you can, what will you do now? You can now remove that uh intra-group. You know, I said it's going to affect both revenue and cost of sale. So that intergroup says now, you will see here, when the first one is 480, right? It means that Kiwi is a seller here. It's set to who? Kiwi sell to who?
Melon.
Melon. So it means that Melon is a buyer. Then the second one, Melon is a seller here. It's sell to who?
Exotic.
So Exotic is a buyer. So when it comes to cost of sale, Exotic is a buyer. Hope is cleared. Huh?
Yes.
So what do you have now? All in general. I think we've computed it that time, 740.
740.
Now, another thing that we also need to take note, it is, I think I explained that one too, unrealized profit. I explained unrealized profit here too. Unrealized profit. So you have to consider if there is unrealized profit. Unrealized profit. And I told you that before you can say unrealized profit, before you can say there's unrealized profit, it is when the person that you sell it to are unable to sell everything before the reporting period. Let's see. Let's see. We can continue from where there is intergroup sales. Who can read it so that I will know that you will see it very well? From that first unrealized profit. One person should read that place so that we know if the actual.
Which place? During 2021, Kiwi had made intergroup sales to Melon of
480.
48,000
Or
naira.
480. 480,000, not 48.
480,000 naira, making a profit of 25% on cost, and 75,000 naira of those goods were in the inventory at 31st December 2021.
Now, look at it. You sell 480,000 to one person, and there is remaining 75,000 of these goods were in inventory at the reporting date. How will you know that the reporting date? Look at it, 31st December 2021, and the examiner is telling you to compute for which period? To compute for December 2021.
2021.
Can you see? It means that the goods are still remain in the inventory. Is it clear?
Yes, sir.
That's the meaning. So as a result of that, you need to calculate unrealized profit. And let's see the percentage we are told. They said when you sell for 480, you make a profit of 25% on cost. Then how will you compute that? To get what they are trying to explain there is that, let me do it somewhere here. You are converting from markup to margin, and you can easily say the formula, it is a cost plus profit is equal to selling price. Now, cost, because they are telling you that you are making what's it called, making a profit of 25% on cost, automatically the cost it is what, 100%. The cost is 100%, and the profit that you make, it is what, it is 25% based on the question, 25%, then which is now equal to selling price. Selling price will now be 125 because 100 plus 25 will be 125%. Are we there? So as a result of this, if you are converting from markup to margin, you want to mark it up to margin, then we have profit over selling price. This profit over selling price, because they say it is 25% on cost, then profit it is 25%. All over selling price is 125. Multiplied by what is the remaining item? This the remaining value of the item, 75,000. 75,000. Then whatever you get is your unrealized profit. How much is that?
15,000.
15,000 is your unrealized profit. So then you take that 15,000 unrealized profit. So who sell? You know, the person that sell, I've already recognized the profit. Then this time around, the person need to what? Need to use it to adjust is the what's it called? The profit. So the person already recognized who sell. The one that we calculate.
Kiwi says. Whistles.
Melon. It is Abi. It is kiwi. It is kiwi
Yeah,
that
Kiwi
sell. Right?
Yes.
So kiwi sell. Then you put that 15. That 15,000. You know, there's 000 here. I didn't put it there. So that is that. Then we do another one. The second one, who can read the second one to us? Whether there's an unrealized profit in that second one of intragroup trading.
During 2021, Melon had made intergroup sales to Exotic of 260,000, making a profit of 25% on sales.
On
And
sales.
60,000 of these sales were in inventories at December 31st, 2021.
So we look at that second scenario as well. It is also the same cost plus profit, which is equal to selling price. But this time around, they are telling us that it is 25% on sales, not on cost. So it means that it is that selling price that will be 100%. Then the profit given to you here, they said it make profit of 25%, then it will be 25%. So what is going to be your cost? Your cost will be 75%.
75.
Because if this one is 100, if this one is 125, automatically something is here to make it 100%. So here, your cost will be what? 75%. So if I want to calculate it now, to get the unrealized profit, it will now be profit over selling price, right? Profit over selling price. It will now be what? 25% divided by
25.
100% times what is the remaining items, the goods that remain before the reporting period, 60,000. 60,000. So what do you have, please? What do you have?
150,000.
150,000.
Ah,
25 divided by 100 times 6,000.
sorry.
15.
15,000.
15,000. So here, who is a seller? So that we also have unrealized profit of 15,000 from here. So who is a seller from that second one?
Melon is a seller.
Melon is a seller. So then we have to put it in melon, because melon already recognized it. Then we have to charge it as expense. So when you total it, we have what? 30. Is it clear? So then you can consolidate. You can consolidate your cost of sale. So what do you have here? Exotic. What do you have? Hello?
Exotic is 790.
17,
790.
790. So please hold on for me. Just give me 2 minutes again, please. So I'm back. What do you have for the second one?
4998.
4998. What do you have on the third one?
5335. 5335.
5335. Consolidated figure
28123. 123.
28123. So this figure, it is what you are using when you are doing your consolidation as your cost of sale. You just bring it there as a working note. You can bring it there. You know, we only compute working note 3. We are still in working note 2. You can refer this as working note 3. So what do you have here? You can put it. You already compute it, which is 17,000. 17,000 what? 790. Then this one
4998.
4,998. The third one
5335.
5,335, and the consolidated one
128.
28.
123.
123. So cost of sales, it is an expense, just as a direct expense. So we have to remove it to get our gross profit. We always deduct cost of sales. I think it's clear.
For exotic, 27810.
I'm coming. So for exotic,
27810.
27,810. Okay.
For melon,
Uh-huh.
19442.
Melon 19
19442. 442.
19,442. Kiwi
16985.
kiwi.
1616.
Okay, 16
985.
985. Consolidated
64,237.
64
234.
23 23 what?
4.
237.
237. So this is your gross profit. But when you remove cost of sales, then this is your gross profit. So if you now move to, all this thing is working notes. If you move to your normal account, you just put it there. Because you already do the working note, just put it there. This is your normal account, your cost of sales. Just put your cost of sales there. What is your cost of sales? Just put it there. Your cost of sales is 28 1 2 3, right? 28 1 2 3. Just put it there. Then when you remove it, you get your gross profit. It is your normal this thing, gross profit.
Yeah, 64237.
Yeah, you can just copy that gross profit from that working note that you are doing. This what?
64237.
This for
237.
3
237.
237. So this is your gross profit. So you now continue from the question. After your gross profit, what do you think they have there? After the gross profit, what is there?
Distribution cost.
Distribution cost. Distribution cost. Then you type it the way it is. Distribution cost. So come to your working notes. If there is no working concerning distribution cost, you put it the way it is. If there is no additional information towards that, distribution cost. So if there is no additional information towards that, towards the distribution cost for exotic, distribution cost for exotic,
37,550. No, 3,325.
3,325.
325.
For melon,
2137.
2137. Kiwi,
1900.
19.
00.
So total
7362.
7362.
62.
So this is the expenses. Expenses need to be deducted.
Okay.
Sorry. So after distribution cost,
Administrative expenses.
coming. So this is what you are picking as your distribution cost when you are consolidating. You just copy it because you've done it. Take it to where the account they ask you to do and put it there. Distribution cost. Then followed by admin, right? Admin expense. So how much is admin expense? So you move to your working notes. If there's no additional information towards that, it's direct figure. Admin. So exotic is how much?
3475.
3475. Melon,
950.
950. Kiwi,
19.
kiwi.
1,900.
Consolidate.
6325.
6325. So this is also your admin. This is also your what? Admin that you are consolidating. So after admin, what is there? Finance cost. So then you can cast this. When you cast, you can get what is called operating profit. Operating profit. Profit before interest and tax. That's under operating profit. The profit before interest and tax. That's operating profit. So what do you get as operating profit? Can cast this one as well. If you cast this, you get your operating profit. Then you take it to that place. The profit before interest and tax. So what do you have?
So for that, for exotic to be 2101 2110
Two,
2101
two.
010
Okay.
16355
16,355. Okay.
13185
18,185. Okay. Consolidate.
50550
550. So this 550 is what we are taking to our report here that he asked you to do. If you calculate it here as well, you get it. So we now move to finance cost. So what did I mention about this finance cost? So that we know whether there's adjustments toward that. Finance cost is an interest. And I said if there's an interest charge
On loan.
on the group, you have to do what? Eliminate it from the finance cost. Is it clear?
Yes, sir.
So is there any additional information relating to that?
No, sir.
So then what is the finance cost of the exotic?
325.
325.
So 325. Then so we don't have for the rest. So the rest is 0. Then here is also 325. So we can cast. So if you cast, what do you have? With that same finance cost, you are taking it here. Because we have finance, we've already get the consolidated 325. So we cast
5225.
huh?
5225.
5.
16.
50.
50
Okay.
225.
So that is profit before tax. Profit before tax. Which one are you talking about? Is it here? 50,
225.
225. What of this? Okay, this one will remain the same because it is zero. 13,
185.
185. So the second, okay, the second one also. So what happened to the second one as well? 16, 355. Because there's no anything that we add to it.
Good.
Okay, what of the third one? Huh?
2685.
20,
685.
685. So that is what's it called? Profit before tax. Then after profit before tax, we can now move to what is called taxation. So let's see. Profit before tax. So there's taxation. So let's see whether okay. You have to bring it here. Profit before tax, which is a 50 225, abi?
Mm.
Yes,
So
sir.
taxation.
Exotic.
Taxation, you have to do the working adjustment. Yeah. Taxation. Exotic is what?
300.
8,300.
8,300.
300.
Okay. Melon.
5,390.
5,390. Kiwi.
4,241.
Huh?
4,241.
4,241. Total.
17931.
17,931. So that is the taxation. So this 17,931, it is what we consolidate. That we take to that consolidation account that we are preparing as our taxation for the three. So So after you remove taxation, then let's see what's the next thing. After taxation, it is profit for the year. Profit for the year. What's the profit for the year?
32,294.
90,
32, 32,
32,
294.
294. So then let's go to the workings, the cast.
Consolidated 32294.
Three profit for the year. I'm listening. From here,
Consolidated 32294.
Twelve
from here,
385.
12,
Exalt
3, 8, 5. Okay,
10965.
10, 9, 6, 5. Okay,
8944.
8, 9.
44.
Okay,
32294.
so this is our profit for the year. Then we check again. Is there any other thing they are giving other comprehensive income? Other comprehensive, other comprehensive income. So what is under it? The other comprehensive income, there's what? The valuation of property. The valuation of property. Then the valuation of exotic and melon. 200
What did you say?
melon,
100.
100. Then this one is 0. So total
300.
300. Then after that, we have total comprehensive income. Total comprehensive income. Total comprehensive income.
What did you see the valuation?
Evaluation, evaluation of property.
What
Have
did
you
you
seen it?
calculate?
So what do you have? So this other comprehensive income, you can put it here because it's after profit for the year. You say other other comprehensive income 300. Other comprehensive income 300. Then you can cast. So when we cast, we have what is called total comprehensive income. So what is total comprehensive income?
That's 31994.
No,
3259.
32,594.
2594.
No, from exotic.
12585.
12,585. Melon
10865.
10,
1165.
Oh, sorry,
1165.
yes.
Okay,
8944. No, minus
8944.
44.
Uh,
32,594.
So this 32,594 is your total comprehensive income. So this is what you are taking to that account. So now, if you look at this statement again, they said dividend declared and paid in the year. What did I tell you about the dividend? What did I say about the dividend?
To be shared.
No, I mentioned something about that dividend when I'm explaining the treatment about investment income. I said investment income from outsider should be what? Consolidated. Any investment income that come from outsider should be
It should be
consolidated.
eliminated. Yes.
The one that come from outsider should be consolidated. Why any income such as what?
Dividends,
Dividend,
receivables, interest.
interest, and other
Should be.
receivable
Yes.
uh, from the subsidiary need to be what? Eliminated. That's why
Eliminated.
that's why I will not consider this dividend declared, because the dividend is actually come from the member, so it has to be what? Eliminated. Is it clear?
Yes, sir.
Hello.
Yes.
So we can continue, right?
Yes.
So then this is our total comprehensive income. You can close it. This is also our total comprehensive income here. You can close it. Sorry. We can close it here. So as a result of that, what you need to do now is to share the profits. You have to share those profits. Are we there?
Yes, sir.
Yes.
So what you do is to do what? Is to share the profits. Now, if you are sharing the profit, it's very straightforward. Just say profit attributable to the profit attributable to the non-controlling interest and also owners of the parent company. Owner of the parent company. So this is how you will share your uh profit attributable to, so let's say profit for the year. So that, because I will still do same thing to other comprehensive income. So profit for the year. Let me write it like that. Profit for the year attributable to non-controlling interest and also attributable to owner of the parent company. I think it's clear. Hello.
Yes.
Yeah.
Now, if you are sharing profit, it means that the profit, or let's say return earnings, not pre-acquisition, retain earning after the acquisition, it means that retained earning, which is the post-acquisition retained earnings, given to you from the question. Which is, let's go to the question. This is Melon. Melon is a subsidiary. So this is the profit for the year. Sorry, I said retained earning. So profit for the year of the Melon. Sorry, it's my mistake. Profit for the year of Melon, which is 10,000. 10,760. Then this profit is the profit that the Melon has already recognized. But because there is what? There is unrealized profit. You now remove the unrealized profit. How much is the unrealized profit? 15,000.
15.
15, right?
Yes.
Mm.
So if you remove that 15, this one is if I want to write it in full, it is 10,760,000, and this one is 15,000. If you remove 15, automatically you've already adjust that profit. What do you have?
10,745. 745.
10,745. So that's the remaining profit. So now you can now say, what is the non-controlling interest when Exotic acquire Melon? The non-controlling interest is what? 10%. Hope it's clear.
Mm. Yes, sir.
because that is the NCI, 10%. So what is going to be your amount now? What do you have?
1,074, or approximately 1,075.
And just call the figure for me.
1075.
1,074.5.
10,
75.
74.5.
that means 1075, like this.
Yes. That's I say approximately.
I believe it's clear.
Onyewa.
Yeah.
Onyemi.
If it is not clear, tell me. You can continue, right?
Mm.
Huh?
Yes.
Yes, sir.
Okay. Then you now look at total comprehensive income. This is the other comprehensive income, the NCI. So if you remove this amount from the profit for the year, in your consolidated, this is the profit for the year, 32,000.
594.
So if you remove this amount, what do you have? What do you have?
We have 31,519.
Okay, that's good. But we have not consolidated it. So let's finish that consolidating part. So then we now look at what's it called? What's it called? Total comprehensive income. You already compute for the profit. Then let's look at the total comprehensive income. Because that one is NCI. So let's look at the total comprehensive income. So let me remove this one first. total comprehensive income. So the total comprehensive income from the question, how much is that? Melon,
10,860.
10,860. 10,860 minus, and there's unrealized profit as well. So what is that unrealized profit?
15.
15,000. $15,000. 15. So what do you have?
Nice. 10,845.
10,
845.
10, 8, 4, 5. Then 10%. So we are still on that, what's it called? Melon. No. What do you have?
1085. 1085.
1085. Okay. Then we can now look at the kiwi own. No, we've discussed, what's it called? We've done melon. We now consider the kiwi. The kiwi. When the kiwi was acquired, there's also no controlling interest. Let's look at the kiwi. So let me put melon here. Melon. Then kiwi own. So profit for the year attributable to NCI. So kiwi, what is the profit for the year of kiwi?
That is
Profit for the year of kiwi.
9439.
9439. So minus, there is unrealized profit as well.
Yes.
15.
Remember, yes, for kiwi own 15. So what do you have?
9424.
9424. Then multiply by, so when the kiwi was acquired, when melon acquired kiwi, so what is the non-controlling interest then? When
28.
they calculate effective control,
28%.
28%.
So it's 9.
So that is why in your question, you will see there that they also mentioned that 28%. You can see the fair value of the 28% non-controlling interest in Kiwi. You can see that 28% that we calculated. You can see that they mention it here too.
Yeah.
So what do you have?
9435.
9435. Then we do the same thing to total comprehensive income. So what is total comprehensive income?
Sorry. Somebody check that figure I gave now. It's like it's not correct. Hold on. Skip on.
IB.
It's 263839.
2639.
Somebody should check that figure. I feel it's not correct.
Okay.
That was
It's correct.
So
so
total comprehensive income. Total comprehensive income of Kiwi. The same total comprehensive income 9439, right?
yes.
Minus the unrealized profit.
Yes.
So what do you have? The same
That is four
amount.
9424. The same amount.
9424 multiplied by 28 what percent.
It's the same thing.
2639.
2639. Hope it's clear.
Yes.
IB, sorry,
Hello.
before you proceed further, I have a question.
Go ahead.
In the percentage, the one we calculated, we said for melon is 10%, and the
Okay.
where there is indirect control. So the effective of that 72,000 and the differences of both, it's 20,000 naira. Why are we using it for melon alone?
Not 28,000 naira,
Ah,
28%.
28%, yes, very.
For Kiwi.
It's Kiwi now. We are not using it for melon. We are
Okay,
using it for
kiwi
Kiwi.
ne, okay. Okay. Thank you. And proceed.
It's for Kiwi. Let me put the Kiwi there. So we can apply it as this total comprehensive income so let's apply the value and let's see. And there's no space, okay? So the non-controlling interest. Non-controlling interest. So what's the non-controlling interest of melon? Total
1075.
comprehensive income. No,
One
total
zero.
comprehensive income. You know this place is total comprehensive income now.
Okay. 1085.
1085.
85.
So what of the Kiwi own?
That is 2639.
Total comprehensive income.
639.
2639. Total. Consolidate.
3724.
3724.
24.
So that's the NCI. So you can now, okay, this one, that is zero. You don't have anything. So you can now cast it so that you can get your total comprehensive income. That will be what's it called? Attributable to owner of the business. That is, you want to get the one that will be attributable to owner of the business. You know, if the total comprehensive income is this one, and you've already got this, so the remaining balance will be what attributable to the owner of the business. Total comprehensive income attributable 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 to parent company. So it means that the one that is attributable to parent company, so this one is 12,000. You are removing this one, then out of 11,065, this one belongs to parent. Then the remaining balance belongs to uh, this one belongs to equity. This one belongs to equity, then the remaining balance will belong to parent. What's the balance?
Deduction, right?
Well, yes,
9980.
9980.
80.
What of this one?
6305.
6305. What of this one?
28870.
28.
870.
28,870.
Yes.
So this is, so let me consolidate the NCI. NCI, you know, this one is our group account. So all those one is just working. NCI. So what is the NCI?
3724.
3724. Then owner of the parent company. Owner of the parent company will be the balance, right?
28870.
28,870.
870.
So hope it's clear.
Yes.
So
Very
this
good.
is what's it called? This is the first part of the question. This is the first part of the question. So by the grace of God, we shall look at the second part, which is the consolidated statement of financial position. So any
All
question,
right.
please? Any question? Any question, please? Any
No
question?
question. No question.
Okay. So in the absence of no question, Then tomorrow, by the grace of God, we shall look at the remaining part, which has to do with consolidated statement of financial position. Financial position. So
Thank
thank
you so
you for
much.
your time.
Thank you.